In this video, we'll show you 3 more stocks Cathie Wood is quietly buying while many investors are heading for the exits. These are businesses that touch billions of lives, generate enormous amounts of cash, and are positioning themselves to benefit from some of the biggest technological shifts of the next decade. By the end of this video, you'll understand why Cathie Wood has been adding to these positions, what could drive their future returns, and whether they deserve a place on your portfolio. Let's start with the first stock, Meta Platforms, ticker symbol META. When most people hear Meta, they immediately think about social media. That is understandable. After all, Meta owns some of the most influential digital platforms ever created. Facebook, Instagram, and WhatsApp have become deeply integrated into everyday life across the globe. But viewing Meta as simply a social media company dramatically understates what this business has become. Meta is increasingly transforming into an artificial intelligence powerhouse, a digital advertising giant, and one of the most important infrastructure companies in the modern internet economy. And Cathie Wood appears to believe the market still isn't fully appreciating that transformation. One of the most remarkable things about Meta today is its scale. At the end of the most recent first quarter, Meta's family of apps was serving an astonishing 3.56 billion daily active users. Think about that for a moment. Nearly half of the planet's population interacts with at least one Meta platform every single day. That kind of reach is almost impossible to replicate. Most businesses would be thrilled to have a few million loyal customers. Meta operates at a scale measured in billions. And scale matters because it creates powerful competitive advantages. Every advertiser wants access to large audiences. Every content creator wants to publish where audiences already exist. Every user tends to remain where their friends, family, and communities already spend time. Those network effects become incredibly difficult for competitors to break. That moat is one reason Meta continues to generate extraordinary financial results despite constant predictions that its best days are behind it. What's even more interesting is that Meta's growth story is accelerating rather than slowing. Many investors assume giant technology companies eventually hit a wall. The logic sounds reasonable. The larger a company becomes, the harder it should be to grow. But Meta has been proving that assumption wrong. In fact, Meta is currently working toward what could become its 4th consecutive year of accelerating revenue growth. That is an impressive achievement for any company. It's especially impressive for one that already generates tens of billions of dollars in annual revenue. The secret lies in how Meta monetizes attention. Every improvement in artificial intelligence allows Meta to deliver more relevant content to users. More relevant content keeps users engaged longer. Longer engagement creates more advertising opportunities. Better AI also improves ad targeting, helping businesses achieve stronger results from their marketing budgets. When advertisers earn better returns, they spend more money. That creates a powerful flywheel that continues feeding itself. This is one of the reasons Meta has emerged as one of the biggest AI winners in the market. While some investors focus entirely on AI chatbots, Meta is deploying artificial intelligence throughout its entire ecosystem. Every recommendation you receive, every advertisement you see, and every piece of content surfaced in your feed is increasingly powered by sophisticated AI models. The result is a better user experience and a more profitable business. And profitability is where Meta becomes particularly interesting. For years, critics argued that Meta's investments in future technologies would hurt shareholder returns. There were concerns about spending levels, concerns about profitability, and concerns about whether management was allocating capital efficiently. But the numbers have been telling a different story. Meta has demonstrated that it can invest aggressively while simultaneously delivering substantial profits. The company continues generating enormous cash flows that provide flexibility to pursue future growth opportunities without compromising financial strength. This combination of scale, profitability, and innovation is incredibly rare. Usually, investors have to choose between growth and value. Growth companies often trade at expensive valuations. Value stocks often struggle to grow. Meta currently presents an unusual combination of both. Despite its dominance, despite its AI initiatives, despite its billions of users, and despite its accelerating growth profile, Meta's valuation remains surprisingly reasonable. The stock can be purchased for roughly 19 times this year's projected earnings. That multiple would be attractive for many mature businesses with limited growth prospects. Meta is not a mature business with limited growth prospects. It is a company actively expanding its AI capabilities, strengthening its advertising platform, and exploring entirely new opportunities for monetization. This disconnect between growth and valuation appears to be one of the reasons Cathie Wood has been accumulating shares. Many investors associate Wood with disruptive innovation and high-growth opportunities. When someone with that investment philosophy starts buying a stock trading at a forward earnings multiple in the teens, it's worth paying attention. It suggests she may see a significant gap between current market expectations and future business performance. And there are several reasons why that gap could close over time. First, Meta's advertising business remains incredibly resilient. Digital advertising has become an essential part of modern commerce. Businesses need customers. Customers spend increasing amounts of time online. Meta sits directly between those two realities. As long as businesses compete for consumer attention, Meta's platforms remain valuable real estate. Second, artificial intelligence is creating entirely new avenues for growth. AI is improving advertising performance. AI is enhancing content recommendations. AI is increasing user engagement. And AI may eventually unlock additional products and services that don't even exist today. Many investors underestimate how much value can be created when a company with billions of users gains access to increasingly powerful AI systems. Third, Meta's ecosystem gives it tremendous flexibility. The company owns multiple global platforms, each with unique audiences and monetization opportunities. If user behavior changes, Meta often benefits regardless of where attention shifts within its ecosystem. That diversification reduces risk while maintaining growth potential. Perhaps most importantly, Meta has demonstrated an ability to evolve. Remember, the company originally gained traction among high school and college students. Many investors assumed those users would eventually move on. Instead, Meta expanded into new demographics, acquired complementary platforms, and continuously adapted to changing consumer preferences. The result is a business that remains relevant decades after its founding. That kind of longevity is not accidental. It reflects strong leadership, strategic execution, and an ability to recognize major technology trends before competitors. Of course, no investment is risk-free. Competition remains intense. Technology evolves rapidly. Regulatory scrutiny continues across multiple regions. And investor sentiment toward large technology companies can shift quickly. But when evaluating long-term investments, it's important to focus on fundamentals rather than headlines. Meta's fundamentals remain exceptionally strong: billions of daily users, accelerating growth, expanding AI capabilities, strong profitability, attractive valuation, and a business model that continues generating substantial cash flow. Those characteristics help explain why Cathie Wood has been quietly buying shares while some investors remain skeptical. The market often rewards patience, and history shows that buying great businesses during periods of uncertainty can sometimes produce exceptional long-term results. For investors looking beyond the next quarter and focusing on the next decade, Meta may be one of the most compelling opportunities among large-cap technology companies today. The question isn't whether Meta matters. With billions of daily users and a growing influence across digital advertising and artificial intelligence, its importance is already undeniable. The real question is whether the market has fully recognized just how much future growth may still be ahead. Cathie Wood seems to believe the answer is no, and that conviction is exactly why Meta earned a place on her recent shopping list. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let's move on to the second stock Cathie Wood has been buying, while many investors remain hesitant. Alibaba Group, ticker symbol BABA. This may be the most controversial stock on today's list, not because Alibaba lacks scale, not because it lacks profitability, and certainly not because it lacks relevance. The controversy comes from perception. Over the last several years, many investors have become increasingly cautious about Chinese stocks. Concerns about regulation, geopolitical tensions, trade disputes, and slowing economic growth have caused many market participants to either reduce their exposure or avoid the market entirely. That caution has created a situation where some investors see risk everywhere they look. Cathie Wood, however, appears to see opportunity, and whether you agree with her or not, Alibaba is one of the most fascinating companies in the global technology landscape. To understand why, you first have to appreciate the position Alibaba occupies within China's economy. Alibaba is not simply an online retailer. It is one of the foundational pillars of Chinese digital commerce. Its Taobao and Tmall platforms connect hundreds of millions of consumers with merchants across an enormous marketplace ecosystem. For many businesses operating in China, Alibaba serves as a critical gateway to customers. That type of market position creates advantages that are difficult to replicate. Scale attracts merchants. Merchants attract consumers. Consumers attract additional merchants. The cycle reinforces itself over time. This is one reason Alibaba has remained a dominant force in Chinese e-commerce despite increased competition and changing market conditions. But if Alibaba possesses such a strong competitive position, why has investor sentiment remained so mixed? The answer largely comes down to growth. Unlike Alphabet and Meta, which have recently experienced accelerating revenue growth, Alibaba has been moving in the opposite direction. The company has now posted 4 consecutive fiscal years of single-digit revenue growth. Even more concerning to some investors, that growth rate has slowed in back-to-back years. Most recently, fiscal 2026 revenue growth came in at just 3%. For growth-focused investors, that number immediately raises questions. Can the company re-accelerate? Has the core business matured? Is the best growth already behind it? Those are legitimate concerns. But investing is often about understanding the difference between a slowing business and a declining business. Those are not the same thing. Alibaba's growth has slowed significantly. However, the company continues to generate substantial revenue, maintain leadership positions in key markets, and produce earnings that provide flexibility for future investments. And that flexibility may be one of the most important aspects of the story. The strength of Alibaba's core e-commerce operations gives the company the ability to pursue entirely new opportunities without jeopardizing its financial foundation. One of those opportunities is artificial intelligence. Just like many major technology companies around the world, Alibaba is positioning itself to benefit from the AI revolution. But its strategy extends beyond simply using AI software. Alibaba is also entering the AI chip market. That move could prove especially important given the evolving relationship between China and the United States. Trade restrictions have increasingly encouraged Chinese businesses to seek domestic alternatives for critical technologies. As a result, companies capable of developing advanced AI infrastructure may find themselves operating in an environment where demand continues to grow. This creates an interesting dynamic. Alibaba already possesses one of the strongest technology ecosystems in China. It already has relationships with businesses, consumers, and enterprise customers, and now it is positioning itself to participate in one of the most important technological shifts of the modern era. That doesn't guarantee success. The AI race remains highly competitive. Execution will matter. Innovation will matter, capital allocation will matter, but the opportunity itself is significant. What makes this particularly interesting from an investment perspective is the disconnect between sentiment and reality. Investors often focus on recent performance, and recently, Alibaba's stock has not delivered the same momentum as some of the biggest winners in the technology sector. In fact, after more than doubling during the previous year, Alibaba shares have experienced a double-digit decline this year. For some investors, that decline serves as a warning sign. For others, including Cathie Wood apparently, it may represent a buying opportunity. One of the most important lessons in investing is that markets frequently overreact. When expectations become excessively optimistic, stocks can become overpriced. When expectations become excessively pessimistic, opportunities can emerge. The challenge is determining which situation you're looking at. In Alibaba's case, investors appear to be wrestling with two competing realities. On one side, there is slower growth, economic uncertainty, and geopolitical risk. On the other side, there is a dominant technology platform, substantial cash generation, a leading position in e-commerce, and growing exposure to artificial intelligence. Cathie Wood's purchase suggests she believes the second side of that equation deserves more attention. And there is another detail that makes her decision particularly intriguing. At roughly the same time she was purchasing Alibaba shares, she was selling shares of another major Chinese technology company. That distinction matters. This was not simply a broad bet on China. It appears to have been a company-specific decision. In other words, Wood wasn't necessarily expressing confidence in every Chinese technology stock, she was expressing confidence in Alibaba. That tells us the investment thesis likely revolves around Alibaba's individual strengths rather than a blanket view of the broader market, and those strengths are substantial. First, the company's e-commerce platforms remain incredibly important profit generators. Taobao and Tmall continue producing the lion's share of Alibaba's earnings. That profitability gives management flexibility. It allows the company to invest in new technologies. It allows the company to pursue emerging markets. And it allows the company to compete aggressively in areas where future growth opportunities may emerge. Second, Alibaba's ecosystem extends beyond retail. The company has spent years building relationships across multiple segments of the digital economy. Those relationships can create cross-selling opportunities and strengthen customer retention over time. Third, AI could eventually become a meaningful growth driver. Much of the market discussion surrounding artificial intelligence focuses on companies already generating explosive AI-related revenue. But some of the biggest long-term winners may be businesses that successfully integrate AI into existing ecosystems. Alibaba has the customer base, infrastructure, and financial resources necessary to pursue that strategy. The market simply hasn't decided yet how much value to assign to that possibility. That uncertainty helps explain why opinions on Alibaba remain so divided. Some investors see a slow-growing e-commerce company facing macroeconomic challenges. Others see a dominant platform business trading at a valuation that may not fully reflect its long-term potential. The truth likely depends on what happens over the next several years. Can management successfully leverage artificial intelligence? Can the company strengthen growth initiatives? Can it continue generating strong profits while investing for the future? Those questions will ultimately determine the stock's trajectory. What we do know is that Cathie Wood saw enough potential to add shares while many investors were heading the other direction. History has repeatedly shown that some of the best investment opportunities emerge when uncertainty reaches its highest levels. That doesn't mean every contrarian investment succeeds, but it does mean that periods of pessimism can create attractive entry points for patient investors willing to look beyond current headlines. Alibaba remains one of the largest technology companies in the world. It remains deeply embedded in one of the world's most important consumer markets, and it remains financially strong enough to pursue new opportunities in artificial intelligence and beyond. For investors seeking a stock that combines market leadership, AI exposure, and a valuation story driven by uncertainty rather than excitement, Alibaba may be worth a closer look. Cathie Wood clearly believes it deserves one. Whether she's right will ultimately depend on the company's ability to convert today's investments into tomorrow's growth, and that is exactly what makes Alibaba one of the most closely watched stocks on her latest buying list. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's get to the third and perhaps most surprising stock on Cathie Wood's latest shopping list, Alphabet, ticker symbol GOOG and GOOGL. There is a myth in investing that refuses to die. It's the belief that once a company becomes enormous, its best days are behind it. The thinking goes something like this. A business worth trillions of dollars has already made its big move. Future growth becomes harder. Returns become smaller. Innovation slows down. Yet Alphabet has been proving the exact opposite. Despite being one of only 3 companies in the world with a market capitalization above $4 trillion, Alphabet has delivered extraordinary performance over the past year. The stock has surged approximately 116%. And remarkably, many investors still underestimate what is happening inside the business. This isn't a company struggling to maintain relevance. This is a company experiencing a growth renaissance. The most impressive part is that the acceleration is showing up directly in the financial results. Revenue growth has now accelerated for 3 consecutive years. A few years ago, growth had slowed to less than 9%. Many investors viewed that slowdown as evidence that Alphabet's expansion phase was ending. Instead, the opposite happened. Revenue growth climbed to 14%. Then it increased again to 15%, and now the momentum is becoming even more impressive. In the most recent first quarter, revenue jumped 22%. For a company of this size, that level of growth is extraordinary. But the story gets even better. Profitability is expanding even faster than revenue. Alphabet achieved an all-time high net profit margin of 33% during 2025. Now the company appears to be on pace to establish new profitability records. Think about what that means. Not only is the business growing rapidly, it is becoming more efficient at converting revenue into profit. That combination is incredibly powerful. Investors love growth. Investors love profitability. When a company delivers both at the same time, it often creates substantial shareholder value. So where is all this growth coming from? The obvious answer is Google Search. Alphabet's online advertising engine remains one of the most successful business models ever created. Advertising still generates more than 2/3 of the company's revenue. Businesses around the world continue relying on Google's ecosystem to reach customers, generate leads, and drive sales. The scale is staggering. Billions of searches happen every day. Each search represents intent, and intent is extremely valuable in advertising. When someone actively searches for information, products, or services, advertisers have an opportunity to connect with potential customers at precisely the right moment. That advantage has helped Alphabet build one of the most profitable advertising businesses in history. But focusing only on advertising misses one of the biggest reasons Cathie Wood may be interested in the stock. The real excitement increasingly revolves around artificial intelligence. And unlike some companies that are still trying to figure out their AI strategy, Alphabet is attacking the opportunity from multiple directions simultaneously. Most investors are familiar with Google Gemini. Gemini continues competing aggressively in the AI assistant market. While it still trails ChatGPT in overall market leadership, its growth has been rapid. And because Alphabet already serves billions of users through its existing ecosystem, it possesses enormous distribution advantages. Distribution matters. A great product is valuable. A great product with access to billions of potential users is transformational. Alphabet can introduce AI features directly into products people already use every day. That creates opportunities that many competitors simply don't have. But Gemini is only one piece of the story. Perhaps the most underappreciated part of Alphabet's AI strategy is Google Cloud. Cloud computing has become one of the most important infrastructure businesses in the modern economy. Companies need computing power, they need data storage, they need AI processing capabilities, and increasingly, they need all three at scale. Google Cloud is benefiting directly from those trends. In the most recent period, Google Cloud delivered an astonishing 63% year-over-year growth rate. That number deserves attention. 63% growth from a business segment already operating at significant scale is remarkable. It highlights just how strong demand has become for AI-related infrastructure. Every company attempting to integrate artificial intelligence into its operations requires computing resources, and Google Cloud is positioning itself as a major provider of those resources. This is where the investment thesis becomes particularly compelling. Alphabet isn't just selling AI tools. It's also helping provide the infrastructure that enables AI adoption across the broader economy. That creates multiple ways to win. If businesses embrace AI software, Alphabet benefits. If businesses require additional cloud capacity, Alphabet benefits. If advertising becomes more effective through AI enhancements, Alphabet benefits. Multiple growth engines are operating simultaneously, and then there's another development that many investors haven't fully appreciated yet. For years, Alphabet developed specialized hardware called tensor processing units, often referred to as TPUs. These chips were primarily used internally to help operate Google's vast data center network more efficiently. Most investors viewed them as behind-the-scenes infrastructure. Now that is changing. Alphabet is increasingly bringing those capabilities to the broader market. Instead of simply using TPUs internally, the company is beginning to market them more aggressively. This represents another potential growth avenue. Artificial intelligence is creating unprecedented demand for computing power. Companies need faster, more efficient hardware to train and run advanced AI models. Alphabet already spent years developing that expertise. Now it has an opportunity to monetize those investments more directly. What makes all of this so fascinating is that Alphabet isn't relying on a single breakthrough. Many technology companies depend on one major product or one major trend. Alphabet has built an ecosystem where multiple growth drivers reinforce each other. Search strengthens advertising. Advertising generates cash flow. Cash flow funds AI development. AI enhances cloud services. Cloud services support enterprise customers. And hardware innovations strengthen the underlying infrastructure. The entire system works together. That ecosystem advantage is incredibly difficult for competitors to replicate. It's one reason Alphabet has remained dominant despite countless predictions that disruption was just around the corner. And it's one reason Cathie Wood may view the stock as attractive even after its massive run higher. Many investors become hesitant after a stock doubles. They assume they missed the opportunity. But investing isn't about finding stocks that have fallen the most. It's about finding businesses whose future value may still exceed current expectations. Cathie Wood appears to believe Alphabet falls into that category. When she looks at accelerating revenue growth, expanding profit margins, rapidly growing cloud operations, advancing AI initiatives, and new hardware opportunities, she likely sees a company whose next chapter may be even more exciting than its last. That doesn't mean the stock is risk-free. Competition remains intense, technology evolves quickly, consumer behavior changes, and investor expectations can sometimes become difficult to satisfy. But Alphabet possesses something many companies lack. It has multiple pathways to future growth. If one area slows down, others can help carry the business forward. That flexibility is a powerful advantage in a rapidly changing technological landscape. And when you combine that flexibility with world-class profitability, a dominant market position, and significant AI exposure, it's easier to understand why Cathie Wood has been buying shares while many investors continue debating whether large technology companies can keep delivering exceptional returns. Alphabet is proving that size doesn't necessarily limit opportunity, sometimes it amplifies it, and that may be exactly what Cathie Wood is betting on. So when we look across all three stocks on today's list, a common theme begins to emerge. Meta Platforms offers billions of users, accelerating growth, and a surprisingly attractive valuation. Alibaba provides dominant e-commerce platforms, significant AI ambitions, and an opportunity created by investor uncertainty. Alphabet combines accelerating revenue, record profitability, explosive cloud growth, and multiple AI catalysts under one roof. Different businesses, different markets, different risk profiles, yet all three share one important characteristic. Cathie Wood believes they may still have meaningful upside despite the concerns currently keeping many investors on the sidelines. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I'd love to hear from you. Which company do you believe has the strongest long-term competitive advantage? Meta's massive social ecosystem, Alibaba's e-commerce dominance, or Alphabet's AI and cloud infrastructure empire? Let us know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.